Hi, welcome everyone to the India market review for the week ending Friday, 22nd September 2017. Uh, we've had a 154-point drop on the Nifty today, about 400 points on the Sensex. There's this news about uh, the bomb from North Korea in response uh, to well, actually, surprising that how much news changes. So till a few hours back, or when I say a few hours, just about 1 or 2 hours back, the big news on all the big channels was North Korea and their threat to detonate a hydrogen bomb on the sea, right? But right now, at least BBC, that thing is gone. BBC had that as the main page. Now it is about UK and Brexit and European Union, etc. CNN still has that North Korea threat. And well, if you start reading it, it's actually quite, you have to wonder what's the hell is happening in the world. Are we really uh, coming to a head here, or is this an amazing amount of foolishness that is playing out on the world stage, and there's no clue as to what's going to happen at the end of this. Right? It's really amazing as to how direct, how um, well, I think maybe crude is too strong a word, but uh, two presidents calling each other dogs, I don't think has, in a sense, at this level ever happened. There's this whole worry about what could happen, and interesting that this area of the range of that missile actually covers some parts of eastern India, and of course doesn't extend all the way to the US, but some very direct US allies are very uh, directly affected. It'll be worth, I mean, if you're interested later, to go and read the actual letter from the North Korean president and the actual translation. Quite interesting in its words. Of course, no less interesting are what Mr. Donald Trump has said at the UN. So anyhow, the basic overall news media as far as India is concerned is that the fall today happened, because of North Korea's threat, and that is what was on the uh, websites everywhere. But now looks like things have definitely cooled down, and well, to say that things have definitely cooled down, here is the madness of the markets in another picture for you, and this is where the Dow Jones, etc., is right now, almost live. It's just 0.07% down, or 0.07, and the Nasdaq is actually in the green just by half a point, and nothing seems to have happened as far as US is concerned. But as far as India is concerned, the NSE down 157%, sorry, 157, sorry, points. BSE down 447 points, but the US basically flat and a little bit maybe even in the green. And if we look at the world indices, then that is all right. So we have right. So where is okay? I keep changing this. So FTSE down right? Uh, Hang Seng down, Nikkei slightly down, CAC actually in the green, DAX just very much flat, and FTSE is actually, that was the US dollar FTSE. This is the FTSE 100, which is actually now in the green, and well, the US markets are all mildly in the green. So, I mean, what the hell is basically going on is, I suppose, a very valid question. And if you look at, for example, the FTSE here, you'll see that half the day it was in the red, and then now it has really gone into the green. And what's interesting about the DAX in the green through the middle of the day, if you see the right side of the screen, now flat. And of course, in the in Germany, we are having the German national elections this week, so it's going to be a very interesting time. And the CAC is in the green. So, I mean, you look at all this and you have to ask yourself, like, what's going on in India? Because you know, the rest of the world seems to be pretty okay, and even the Nikkei very much ahead of Indian time, or the Hang Seng down 0.25% or 0.82%, but India down much more than that. So, is the Nifty down basically because of global factors, or is there something local which is going on and lurking? And what's not obvious? So clearly, what the Indian market has done is disproportionate to what the global market has done, and we have a much bigger fall than any of the global peers. And so, to think about it, there are definitely a few factors. Um, I think one of the main factors, perhaps, if we have to ascribe reasons, is the slowing GDP growth rate, 5.7%. And if anybody has been watching the news and the TV, a very reluctant Arun Jaitley having to admit that sometime a few days back on TV, and very sort of, obviously uncomfortable, obviously cornered, saying that yes, this has to be discussed with the prime minister, and something has to be done about it. And I think in today's Business Standard or Economic Times, there's something about a fiscal push. Basically means the government of India having to do something about it by spending money on public projects in order to stimulate the economy. Things are definitely not as rosy as the government likes to believe, or as um, optimistic also as the government likes to believe. And maybe, who knows what the truth is, the things like demonetization, the GST drive, and all that has really maybe knocked some steam out of the system. And maybe the market is now really looking for what really is going on beyond all the nice big talks and lectures and speeches by our prime minister. Is there any substance to the whole thing? And what's going on? So maybe the market is waking up to that reality. And in terms of just very quickly looking at uh, the what's on the money control website right now, there is what clearly this thing about NBFCs and private banks can't drive growth, and that's why government capex or capital expenditure is key. A lot of talk about the overall average or the standard GST rate being definitely on the higher side, and all the technical glitches that are been reported in filing the GST returns. So more and more, bad news or bearish news or negative news than bullish news as far as the economy, etc., is concerned, right? Uh, so really, in terms of economic factors, macro factors, political factors, current affairs factors, the situation, in my view, is quite negative. I can't really think of anything really majorly positive in terms of any of these sort of issues, right? So I think on a sentimental, which translates into a technical picture of the markets, things have become, especially over the last 1 week, um, more and more negativity that has come into the system, and really no, um, I would say, great visibility on anything that might be very positive going forward. Right? So that's the macro view that is there. And now getting into the technical analysis of the charts. So clearly the Nifty big Marubozu red candle today. This is a daily chart. If you look at a weekly chart, you know, clearly this is still there's been a nice recovery after this big fall, 4 or 5 weeks back, and I'm sure some of us are hoping that there'll be another recovery again like this. But when these sort of moves start to happen again and again, and you see these sort of bearish candles, clearly, like I put in the title for the IMR today on the post, uh, are the bears taking over, right? And it definitely looks like the bears are taking over. I think that's at least my interpretation, my view. And in addition to that, there's really nothing on the charts to suggest that we have, the strength. At the very least, the strength of the bulls has considerably reduced. We now have a MACD. This is the weekly chart, by the way, MACD crossover, but still very much in the bullish territory. So we'll have to see how this pans out. RSI trending down, and in a sense, a sort of double top at around 10,130. Not a very good one, but nevertheless, in terms of weekly charts, is potentially in place. And on the weekly chart, we have this bearish engulfing twice, and we'll have to see what happens. Now, I would have, stuck my neck out and very strongly said that the market is going to go down quite a bit. But looking at how the global markets have reacted, have to really wonder how the reaction could be on Monday. Is it possible that this? All right, so there we have it. Let me just use that itself. Yeah, that's a support line, resistance line, and is it possible that we come there maybe on Monday or Tuesday, and then we bounce from there somewhere near the 50-day exponential moving average? So that's around 9,900. And also remember, next or rather, yeah, not the next week, I was going to say this week, next week is derivatives expiry on 28th of September. So where are the derivative positions held in the market, and how could that affect the market? So 9,900, very convenient in terms of strike prices, in terms of 50-day moving average, in terms of a support level. And it could be interesting to see whether this is where the market holds in next week. So a tough call, but 9,900 is perhaps a point of reversal, and we'll have to take a look at what happens next. So for all the noise in Indian media about North Korea, looks like the Western media is really not too bothered about North Korea, which forces me to think that there are actually, the news machine is basically going to find a reason and ascribe some reason or the other to every event that they want to talk about. But when you start to look deeper and think broader, um, if North Korea was such a big issue for the world, then well, I think very fair to say that the European markets and the American markets would have also reacted, but clearly they have not. So that makes one wonder what is happening in India, and obviously North Korea can't be the issue. And that's why I come back, as I already mentioned, to the local factors, the GDP factors, the the market looking for looking at maybe the ground reality of the economy, and maybe the talk is no longer enough to support the market, right? So interesting times, maybe interesting time to sort of see how the market shifts its focus and attention from various factors to other factors, and then the swing keeps happening. So good time to understand that swing. All right, so 9,900, important point to watch out and see how the market behaves around that. Um, um, let's look at where the global indices are before we jump into the sector indices. This is the Dow Jones index. This is till yesterday. So this is not including today's data. So today, as you know, it's very much flat. So you can see the Dow Jones very clearly, strongly trending up 22,400, and looks like, there's really, if you look at it from a bigger perspective, many months, more than a year here, clearly, quite strong and headed up. The S&P 500, the broader market, very much the same. Yes, we have a hanging man picture there. We seem to have an evening star there as far as the S&P 500 is concerned, but right now the US markets are pretty flat, right? So still too premature to say that. They definitely know there's maybe a short-term reversal, but the longer-term trend clearly for the S&P 500 is up. You can see this also. So on a multi-month basis, uptrend very much intact. If you have looked at some of the economic reports for the US, there's expected to be a lot of consumer spending, strong spending in the US in the coming quarter. So quite optimistic about earnings upgrades that may happen in the US. Moving on to Europe, looking at DAX. So German national elections this week. Interesting time to see whether Angela Merkel will get re-elected or not. There's also some news that for the first time since I think World War II, the extreme right wing, the Nazi parties may have a chance to get a seat in the Bundestag on the back of the massive immigration and refugee crisis from Syria and North Africa, etc., and people really not liking it anymore. So anyhow, the DAX clearly trending up, has sort of a flag, seems to have broken out, and that's a pretty positive move. And the downtrend, which was there for about since June, so June, July, August, 3.5 months, clearly over, and clearly an up move in place again, with perhaps a view to take out the life high and then go further up. So that's interesting. Looking at France, very much the same picture, has reversed track. So DAX and France going almost hand in hand. Really nothing much more to say. The CAC has also broken a resistance of 5,250, and who knows, may go back to uh, its yearly life high at around 5,450. Coming to FTSE, where the Brexit negotiations seem to be getting tougher and tougher, and Prime Minister May there has to now sort of try and break the uh, deadlock between the EU negotiations and all. And she's made a speech just a hour back, a little conciliatory towards the EU, and looking for middle ground. But clearly, you can see that the FTSE is really going nowhere. So while the rest of the European indices are clearly trending up, the FTSE is very much at best sideways and perhaps set to go a little down further, probably till some much better clarity happens on the Brexit. Maybe the FTSE is really going to be languishing around sideways for the foreseeable future. Mostly for the sake of completion, if we look at the Nikkei, then well, Nikkei now clearly going up, just like the way the the DAX and CAC are. Right, so FTSE sideways to slightly downward move also over. So across the board, unlike 2 weeks back when we did the previous IMR, things have turned very bullish. Right now, obviously, the Indian market is going in the opposite direction, and this is a and what's interesting and consistent is in the last 2 months, while the global markets have been sidewards to bearish, the Indian market was bullish. Now that the global markets have been clearly bullish, the Indian market seems to have turned at least slightly bearish in the short term this week, right? So very clearly, the Indian market and the the global market seem to be doing different things, doing separate things, and really not integrated, or integrated in the sense of being coordinated and synced up in their behavior. So I'm not so sure, given this observation, how relevant global factors are on the Indian index. And looks like it's been the way for at least the last few months. And from all we can see right now, it seems to be the case even now that the global markets really seem to be doing their thing, and the Indian markets seem to be doing their own thing here. So looking at Nifty again, 9,900 is the level to watch. Uh, and we'll know that only next week. Till then, actually, really no particular view on the Nifty itself. If 9,900 breaks, then the next level I would look at is 9,850, and then look at 9,700. But we are in the sense in the middle of no man's land. Today's volume, nothing really exceptional, no great volume to say that there was a lot of selling. So is this just a reaction, and things will settle down over the next 48 hours as the weekend passes by or not, is really a tough call to make at this point. So let's move on to the sector indices and see how the sectors are behaving. Before that, just looking at the Nifty Next 50, clearly that made a new life high, but that has also turned sharply right now. So just to invite your attention, this is what I'm talking about. We had this sharp bear grip. We had another bear grip here. We had clearly another strong bear grip here, and now. So in other words, the bears are making their presence felt, I think, on a very regular basis now. Though the longer term trend, as in the multi-month or even the multi-year trend, is clearly still up. We are still getting higher tops and higher bottoms, though the what would I say, the rhythm and the smoothness with which we're getting higher tops, higher bottoms is getting pretty volatile. And looking at the weekly chart on the uh, Nifty Next 50, this is what we have, And well, you have to ask whether this is looking now like a rising wedge, right? To me, it looks like that, right? To me, it definitely looks like a rising wedge. To be so, rising wedges are never a good sign, and if this boundary breaks, which may have broken, may not have broken, and I'm saying this again, insisting that this is on a weekly chart, then usually rising wedges don't end well. 9 out of 10 times you will see once they are decisively broken, the market goes into a deep, not deep, but a very swift and a sharp correction, which could turn out to be a deep correction, right? So, not a very good technical picture with this rising wedge. There is no rising wedge as far as the Nifty itself is concerned, but there is a rising wedge as far as the Nifty next 50, earlier called the Nifty Junior, is concerned. Looking at the CNX 500, the broad market 500 stocks, well, clearly no wedge here, but the bear grip slowly getting stronger, in my opinion, can be seen on the indicators, more or less just like the Nifty. So CNX 500 clearly at a life high. Just want to mark that off. All right. So now getting into the individual stocks, let's look at the Bank Nifty. So this is a weekly chart. Really nothing to say except that very much lookalike of the Nifty itself. So the Bank Nifty and the Nifty very much in tandem. So the Nifty being clearly affected by the banking stocks and how they behave. Um, the patterns being almost mirror-like, very, very identical in in the weekly chart. And as far as the daily chart now is concerned, very clear double top. The double top is not so clear on the Nifty, right? This is not such an obvious double top, but on the Bank Nifty, the double top is, I think, absolutely clear. And 25,150, 25,200 is a clear double top for the bank stocks. Until this gets cleared, one should be a little careful of being long on banks. So Bank Nifty has come to the 50-day exponential moving average, sitting there. Whether it's going to break or not, tough to tell. But I think there is no strength as far as the picture is concerned. Uh, Even if this does a bounce from these levels, it may not go back to 25,000, and 25,000 is most likely a short-term resistance in the days to come. Talking about banks, the Federal Reserve did their thing yesterday or today and have started unwinding their banking. Where is that? Yeah, right. Okay. So Fed leaves the rates unchanged, right? Uh, and really no, so there's no cheaper money, no more expensive money, and they are winding down uh, uh, the quantitative easing. And the Fed also said that the forecast of 4 rate hikes through 2018 is still very much on the table, right? So that expectation of a softer Fed has definitely not panned out. So really no hope on that front. Now, if the Fed does not reduce the rates there, and it's holding them steady with a view that they'll actually get increased, there's not very much that India can do, or the rest of the world can do for that matter, in terms of reducing our rates, right? So while the government of India desperately wants that, and they'll want this even more with the slowdown in the economy and the GDP at 5.7%. The RBI is unlikely to be able to budge on that. So you've got a sort of interesting, uh, difficult place where maybe the economy does need lower interest rates, but the US is actually saying they're going to increase. You want to um, attract money into India, then well, and also hopefully maintain your foreign exchange rates, then you would definitely prefer to hold on to the current interest rates in India. Which brings us back to the broader picture that we were discussing earlier. Will we see perhaps some sort of tweaking in the coming weeks and months? For example, we all know that the SUVs were now taxed a little higher than about a month back because the cess was increased. Um, and will the government come out with a face saving thing where not just for SUVs but for a whole range of things they might tinker around without having to admit that the economy is in trouble, tinker around to do something to reduce the tax burden, makes things cheaper, and therefore perhaps try and stimulate the economy. So can we expect cheaper things in the, I don't know, months ahead? Watch out for that. Maybe you want to think about your any big time purchases and hold on to them for some while in that expectation. Right? Okay. Along with the banking stuff, I think one other thing which is now going to come to the fore in the banking area is the NPA buildup, which is not a good thing, of course, but with the slowing economy is likely to get worse, and that becomes one sort of vicious negative cycle. And you have the already high NPAs, you already have high defaulting firms. Economy slows, then some other companies which are able to service their debt are not able to service their debt, and already the many of the public sector banks are in a pretty financially weak situation. And then how do they first of all get capital, as it is was going to be a challenge, and with more NPAs probably coming out of the cupboards, then are we going to see even worse things in the near future? So the banking space is looking more and more iffy, looks like, and we'll have to see how that really pans out in the weeks and months ahead. Overall, fundamentally, macro wise, that is not looking good at all in my view. PSU banks, look at it, they were already doing badly, as we had already discussed a lot in the several IMRs back, and now they have broken that very, very important resistance support zone. Already they had done that, but now with the sort of fall they had today, big negative in every way. So PSU banks, definitely we should not have been in it, as I've been constantly saying. And right now, I think there's even worse news on the PSU banks coming forward. This is the weekly chart, and on the weekly chart, they now have broken the 200-week moving average. That means approximately we are talking about the 5-year moving average has also been broken down, and the trend seems to be accelerating further. Lower highs, lower tops, lower bottoms, very clearly seen in the uh, weekly PSU banks. So PSU banks, more or less, I think very much a clear shot. Uh, Obviously, the bank Nifty overall not that bad at all. So the dichotomy between private sector banks and public sector banks continues to happen, and I really doubt whether that's going to go away. So probably if you have stocks, banking stocks, public sector banks definitely should be sold slash shorted, and private sector banks are the ones to potentially be long on, right? So bank Nifty very likely, I think, to come to at least 23,600, and then if it breaks that, then clearly the uptrend is over and we have a clear downtrend in the bank nifty also, right? Right now, if you look at the daily chart of the bank nifty, somebody could argue that we are in a sideways market. We are not yet in a downtrend, but it's just another, maybe, yeah, just another 300-400 points down. One more bad day like today and we could see bank nifty getting into lower tops, lower bottoms. All right. So overall, get out of banks, definitely public sector banks. Looking at the other indices in order, like starting with auto alphabetically. So here's the auto index clearly hitting a double top and retreating on a daily chart and on a weekly chart, right? So if I have to uh, use that same thing here, so that's another rising wedge that we have on the auto index. Again, not really good news. So we saw that on the banking stocks, rising wedge. We are seeing this in the auto index. Not good news at all, right? Really, really not good news. Auto is another big thing, and also with of course, Dasara, we are in it right now. In a month from now, we'll have Diwali, so it's the festive season, and will be interesting times to see if the autos have topped out, which they seem to have, at least as far as the um, uh, weekly weekly chart of the auto index is concerned. Let me go back to daily. Right, three black crows, very decisive, and probably further down moves on the autos. Capital goods, so had broken out of a resistance, clearly have been really hammered back down. They were on their way to clearing that resistance and maybe even make a new life high. At least for the short term, that dream is over, and the capital goods, okay, on a weekly chart now, looking a little more positive. Is still the chance that it could come down and break out from a longer term perspective. This is almost like one multi-month or multi-quarter flag, 13,800 to 18,000, almost 5,000 points, about 1.5 quarters of consolidation, and then maybe it breaks out. So that can't be ruled out still, but and yeah, so here's a point to think and remember, or keep in mind rather. If the government announces some sort of a fiscal package and incentives for capex, and capex means capital expenditure, so things like roads, electricity lines, bridges, all that sort of stuff, then to sort of stimulate the economy, then the capital goods space is definitely one space that could benefit quite significantly, because then there'll be a sudden demand for those sort of equipment. So there are, in a sense, opportunities to go long, potential to go long, and this is not necessarily it is definitely not the worst case scenario. Maybe just a technical pullback, and who knows, it goes back up. So not bearish, but definitely sideways, and definitely the up move temporarily halted. FMCG, so FMCG was already down, had gap down, gapped up, gap down, and of course not all the FMCGs was because of ITC, and ITC is a major heavyweight in the FMCG index. Actually, some of the individual FMCG stocks have done really well. If you tracked the IMR we did 2 weeks back, where we looked at mid cap stocks, quite a few of them were FMCG stocks, which were very, very bullish. Okay, so that's the FMCG space. Clearly, not bearish, showing some strength, could really take support at this bunch of moving averages, 100-day, and move up. And again, the consumption story very much intact and going to increase with the festive season that we are having. Um, Healthcare, right, was going in a nice uptrend, could really still be a nice just a correction and could still go up. So IT Healthcare is recovering from almost a 50% fall from its life highs of almost 18, 19,000. It had gone down to 12,700 and now seems to be going back up. But can't be sure that the uptrend is there. You can see that on the longer time frame in the weekly chart, we still have a downtrend, lower tops, lower highs, right? Uh, Having said that, nah, okay. Let's see monthly, right? So look at this. I mean, indicators. Monthly chart, rarely we look at it. Clearly, the RSI, MACD, everything, very, very bearish, very strongly trending down. So in the sort of multi-month time frame, things are looking bearish. In the weekly time frame, uh, just a little bit of hope in terms of the RSI here, okay, and also the stochastic here, okay. And but this is really way too weak to say there's anything substantial, but worth watching and tracking to see if something does pan out here and we see an up move. It could just be a small up move, maybe back to 14,750, 14,000, or even 15,000, and then who knows, come back down. So um, healthcare, yes, short-term uptrend, but look at this on the daily chart, cross the 50-day, then the 100-day moving average, but 200-day moving average is definitely going to be a challenge, and we'll have to see how that pans out. IT is the definite interesting, I would say, in a sense, surprise. It has, a red candle here, but if you look at the CNX IT, okay, so this is the BSCIT index, which is red, and all that consolidation still going on, not moved out of that triangle in a sense. Right, let me bring that and just leave that there. Just cluttering the chart. And right now, one could say, this is perhaps the line to watch, and just to see how the market behaves around this, right? Uh, a triangle, symmetrical triangle, clearly going on in play. Question is whether it is going to break out or break down. Way too early to say what is likely to happen. For the last 2 years, 2.5, 3 years also, in some individual IT stocks, consolidation, sideways move. And one good news, I think, that H-1B visa, that the US government immigration service started the fast track process also. So I think there's some relief on that. And some IT companies did actually quite well today. Right. So interesting that CNX IT actually green candle, BSC IT slightly a red candle, but overall similar picture. And that's just because of weightage issues and things like that, right? So here's the other thing to keep in mind on the CNX IT. Long-term downtrend has decisively been broken from 2015 onwards. This downtrend has been broken. The index went out, broke out, came down, took support on that downtrend line. So that downtrend line is now behaving as a support line. The moving averages, and this is the daily chart, remember, have turned around, have gradually started to move back up. And it is, I think, quite feasible that uh, the IT sector, at least financially, seems to be in India making some sort of um, recovery. And who knows? Clearly, market is in a bullish uh, phase as far as the IT sector is concerned, and pretty tight. Symmetrical triangle. I think it's just a question of time. That 1 or 2 weeks, next week again expiry. 1 or 2 weeks, 1 month max, when this symmetrical triangle's direction breakout, breakdown, or breakout will be decided. By the looks of it, looks bullish, but that's just an opinion. always wait and watch and see what could happen. If you look at it from a weekly chart on the IT side, then clearly consolidation, and too early to say sustained uptrend is there, but looks like the bearish move is over and the bullish move is going to set in. One thing to remember, and just crossed my mind, that there's a cat somewhere. Uh, One thing to remember is that uh, if the Indian economy does badly, if the GDP comes down, if the government is forced to do this spending, etc., it will, at least traditional economics says that, and things are going crazy nowadays. That's why I said traditional economics says that the foreign exchange rate of that country should weaken, and if the foreign exchange rate for the rupee gets weaker, which means more rupees to the dollar, then good for the IT companies, right? Good for the IT companies, and they would make more profits in rupee terms, even with the same dollar revenue. So that is something that might be playing out on the IT uh, space. That even if the economy is worse, the rupee profits could get stronger. Now, if you look at this weekly chart, almost looking like a ascending triangle, not exactly. So if this is the high, this is the high, this is the high, but yeah, one could argue it's an ascending triangle, and if it breaks out, then 10,100 to 10,800, 700 points, about a 7% up move on the IT index is a possibility. Could take a whole quarter or 6 months for that to happen. All right, so IT looking promising, which is interesting given all said and considered in the market that we've seen. Metals looking really beaten down now, so they've had a really good run. And look at this, talking about technical analysis, came to a resistance, right, which was there, which we this line has been on the chart for years now, or okay, not years, months. This horizontal line of resistance around 13,900 has been there for a long time, and resistance has been hit. It's clearly been beaten down from there, right? Doesn't mean that it's going to really go down a lot, but yeah, beaten down. We'll see 2 years, not 2 years, about 1 2 3 4 5 years of sideways movement on the metal side. Again, you know on the fundamental side, more and more of the metal companies are working close to capacity, uh, factory capacity. Some are in expansion mode, like SAIL is increasing its capacity from 13 million to 21 million tons, which is for take 2 3 years. It's not going to happen overnight, but just getting the sense that uh, plant capacity is being used to pretty much the max. Now, having come to this resistance at 14,000, now technically could it go back to 6,600, which will be like a 50% fall, and then consolidate even more for a few more years and then break out? Yeah, could happen. Likely, probably not at this point, right? Technically looks like in the short term, uh, definitely bearish, but after that, after it breaks out of this double top or multiple tops, let's have a look again. Yes, double top, right? Then we could see a much bigger move in the coming weeks, but for now things are looking pretty bad for the metal index. So, however, and you'll see this probably for many of the sectoral indices, a lot of the long-term moving averages are just below um, you know the price action, and any of those could give good support from where the markets could turn, right? So watch out for that. Looking at something closely related to metals, the realty sector, and that's again in a sense not in a sense, clearly become weak, sort of a rounding top formation there. It had already fallen yesterday, or rather Thursday, and continues to fall. Had come to the resistance zone again, as you can see here, sort of a triple top now, and we'll have to see how it pans out from here. Uh, Given the technical picture, look at this. This really good resistance zone which is there, as or not resistance zone, so consolidation zone that has been going on for 3.5 years on the realty index, right? So this is uh, um, technical reaction. Fundamentally, when we do the deep fundamental review in the coming days and weeks, we'll get a better picture. Yeah, the point I wanted to actually say, I guess keep slipping my mind, is once this 2,300 level gets taken out, or 2,000, let's say 250 level gets taken out in a decisive fashion, you're breaking a triple top, you're breaking a 1, 2, 3, 4 year consolidation. And if you look at the depth of this consolidation from 2,250 to say 1,200, just to be a little conservative, you're talking about 1,200 points. From 2,200, 1,200 points will be 3,400, almost a 50% up move that could happen once it moves up from here. Now, that is a big if, and we'll have to wait and watch, given how the overall economy seems to be looking right now. Might be a little iffy, but here's the thing, and this is, I think, what we need to pay attention to in the coming days and weeks, is a surprise government announcement about a fiscal push. To take you back a little bit into history, about 8, 9 years back, when the 2008-9 crash happened, you may remember that Pranab Mukherjee had reduced excise duty, if I remember correctly, but some duty across the country for all items by 2% or 1%, as as a as a way of stimulating the economy through lower costs. And looks like it worked. It really did well for some time. And of course, any such measures can only last for some time. And then the excise rates and all those things were brought back up to the pre-crisis levels. We don't have excise duty now, we have GST. So an announcement by the government saying something like, so we have 4 GST slabs, saying all the 4 GST slabs rates will be reduced by say 1% or 2%, could definitely be on the cards. And if that happens, then things like housing, things like capital goods, things like cement, everything, obviously becomes cheaper. And the small middle income housing may take a push, and the realty stocks could positively react to that. So don't be surprised if some sort of government effort towards something like that stimulates the markets and then makes it go up, right? Especially for sectors like this, as in reality, which have been consolidating for a long time, and long time as in almost half a decade. And of course, metals also, not at their life lows, reality really coming out of their life lows in a sense, from these levels, but metal, definitely above the 2008 crashes, and then who knows. So these two places, realty and metals, are coming out of multi-year downturns, but something like autos and what was the bank Nifty? Yeah, right. Yes, bank Nifty, autos, and there was something else. I'm forgetting, one second. Which FMCG, right? Those are coming off their life highs. So really interesting contrast as to how different stocks and different sectors are almost, in a sense, technically at opposite ends. And this gives us an opportunity to actually see, or rather for different types of traders, investors, those who can shorting opportunities are probably there. Those who can go long, going long opportunities are also obviously there. So very clearly, autos, uh, again IT, something coming out of a longer term downtrend. Uh, and have I missed anything here? Let me look at right. And energy, right? So energy is a mixed bag. This is unfortunately CNX Energy is only from 2012. There is BSC Power from, I think, also the same thing. So that doesn't go back too much. And yeah, all right. So CNX Energy really not a very long-term history, but had been, all the oil marketing companies, etc., had been going up, 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 and you saw the news coverage about how petrol and diesel prices are higher than 2014, while the international crude oil price is half of what it was in 2014. And that's because of the special duties that have been increased and increased and increased on the petroleum products. So that's another place where the government might announce a decrease in the duties and taxes on fuel, and that has a cascading effect in terms of making transportation cheaper. Everything, therefore prices come down. And if that happens, then uh, again it will be indirect stimulus to the economy. So watch out for announcements by the government of India, finance ministry, Arun Jaitley, about GSTs rates, about the cess, and about fuel taxes. Any I'm sure one thing is very clear, that they're not going to be raised. Any hint or obviously an announcement that they're going to be reduced is a potential kicker for higher levels, right? So just to go back to what we were discussing earlier, just 3 minutes back, I was talking about how some sectors like realty and metals, right? Let me get the whole picture, right? And IT, right? So, okay, especially realty and metals coming out of multi-year consolidations from a low base. Things like IT coming out of 2 to 3 year downtrend, and then we have uh, capital goods, which are also, yeah. So these three coming out of downtrends, and pharma, yeah, that was the other one, which is looking like it is after cutting off almost 50% of its market cap in the last 2 years. So let me make a note now. Metals, realty, pharma, IT, right? These three sectors, major sectors, right? All three coming out of either multi-year consolidations or multi-year downtrends. Then we have things like auto, uh, query, I will say banks, because it's not very obvious in terms of private sector banks. Then we have auto bank, energy, right, as basically oil and gas is what we are focusing on here. And then I would even put capital goods here, as in stocks, sectors rather, which were going into uptrends and or in uptrends, which are now coming off their highs. And FMCG also, perhaps FMCG. Okay, but FMCG again, query, because individual mid cap FMCG stocks actually doing very, very well. It's this large cap ITC heavy index which is not doing well, right? And yep. So basically the dichotomy in the economy of some sectors coming from from their bottoms, and some sectors coming off their tops. And this is in a sense what is called, I think, an excellent example of a practical understanding of the concept of sector rotation. Those of you who are not familiar with it may want to Google it up. And something that we should perhaps have a session on as far as the mentorship group is concerned, how money moves from, or investment attention moves from one sector to another as each sector's um, future prospects change over a multi month at least, and often a multi-year period of time. And it will be a great idea to revisit this conversation, to review this discussion in the coming days, weeks, and definitely many quarters, to see how this whole idea pans out over a much larger period of time. And I say this because we tend to completely ignore the long term in our pursuit of short term profits. And it's very difficult for people nowadays, in this WhatsApp era, Facebook era, to actually get a sense of what's happening in the bigger picture. And I have to probably give a disclaimer here, which is that I am appreciating the bigger picture and the longer time frame and the bigger time frame much more, much more than I used to maybe just a few months back. Partly because I think my way of participating in the market, when I was once upon a time a day trader for almost 3 years, enjoyed that really well. And now I'm more and more looking at positional stuff, and also just shifts in priorities in life about how I want to go about spending, how much time and effort and attention I want to spend in the market. So all those combined are giving me a better appreciation of the longer term, and especially when you look at the charts like we saw today, this sort of sector rotation is something that you will make out much better. Let me see if we have this. I'm not sure. Let me just check one sec. So that's what's on the screen in terms of away from the tops, and this is coming off the bottoms. Next is, let's see. Okay, yeah, correct. Okay, in case you're wondering what I'm doing and what I'm up to. So this is to give you a sense of this whole sector rotation business. I'm not sure how. All right, so this is a relative performance chart. This is not an absolute chart of different indices, right? So you can see that we have from NSE in that color, Bank Nifty, auto, capital goods, consumer durables, capital goods, FMCG, healthcare, metals, and realty, right? And this is all the BSC indices. And right, okay. And you can see that this is from 2009. Actually, I would prefer to just say it from, let us say, 2010 or even 2014. And the reason is to just sort of, after the 2008 recovery. All right. So if you see here, this is what I was talking about, relative performance. The healthcare thing, which is here, was, really doing not was doing really well up till 2015. There's all your pharma companies and all that, and you can see how its performance has degraded in the last 3 years. And here at that time, FMCG was doing really badly, and the green line, and how FMCG has done really well in the last few years. And you can see on the FMCG index, by the way, a sort of head and shoulder top there, right? Which is relatively saying that maybe that performance is coming, getting over great performance. Other sectors which have been doing well, the light green here, which is your what is this, Bank Nifty, right? Bank Nifty here, this doing well, still doing pretty okay. Uptrend is there. In the purple, you can't see it, really bad coloring. CNX IT here, this in the purple here, Okay, CNXIT doing was going down. As you can see, CNXIT was going down for the last 2 years. In the last 1 year, started to perhaps go up, but too early to say. Uh, the Nifty NSE 50 is still going up. Since it's a relative performance, it's basically saying how much percentage each one has gone versus the other. And what's really doing not well is here, the zero line, the center line, the capital goods space, right? The capital goods space consolidating, going sideways, and everything below that, you can see that, for example, the one which is doing the worst here, which is realty, right? Very similar color to healthcare. Sorry for the confusion. So this is your BSE realty, which has just stayed at the bottom for 3-4 years, and along with that, this other one is metals, and you can see how these have started to recover from their bases, right? So all these sort of, in the sense, the four at the bottom. So we have realty, we have metals, we have uh, ignore this one, I had to put this because of a technical reason, and we have capital goods, right? So all these three showing signs of recovery, and all these four on the top, autos, pharma, banks, etc. Sorry, autos, banks, and uh, what was that? Got too many things in my head. And energy, sort of doing relatively poorly. So this is what I mean when I say that the opportunities for everyone, something for us to investigate deeper in the coming days and weeks, and understand, uh, maybe at this point, more than actually finding trades and opportunities, understanding how the longer term trends over quarters and years change. And for those of us who are especially long-term portfolio investors or managing larger amounts of money, this sort of a study would be extremely useful and insightful as to what to expect in the coming, say, at least I'm sticking my neck out and saying 1 or 2 years, and then therefore knowing which sectors are likely to perform better vis-a-vis the other. The whole idea being that we want to park our money in those sectors which are going to be superior to others. Like it's emotionally, we derive a lot of satisfaction out of performing better than others, much more than absolute performance. It is relative performance that brings us most happiness. May not get us the best results, but gives us the most happiness. But when it is done objectively and done with data and research like this, and this is just the tip of the iceberg, then you will actually really find great opportunities and discover what is working well and what is not. Right? This is since this is a relative chart. If I zoom, these things will actually look very different. Now if I look at it from a 2 year perspective, you will see that the metals here have done extremely well, right? Metals here have done extremely well, and if you look at the bright green here, that was your FMCG, has gone really to the bottom. So understanding this is going to take time, because the base effect is what makes these lines change in their order and in their ranking and in their performance. But once you get around it and understand it, it really is an amazing way of understanding sector performance and how things are moving vis-a-vis another. Right. All right. So I think after a very, very long time, I've done this sort of a review on the IMR in terms of sector discussion. I hope it was a good insight as to what more can be done, and I intend to do that in the coming weeks. So for those who are interested, keep your eyes peeled, look out for the announcement and the sessions, and hopefully you can join them more live than uh, watching the recorded ones, because then we can probably have a really, really good discussion around it. Right. All right. So been a, I think, the longest part one of the IMR for a pretty long period of time. I hope that gave us a good idea. So to answer the question, bull grip or bull trend, bear grip or bull trend, I would really think that we seem to be in still technically a bullish market, chart wise, but I think when we look beyond technicals and beyond charts, or even if you just look at technicals, the frequency with which you're seeing big red candles happen on the major sectors is definitely a concern. Having said that, there are these other sectors which are coming out of their bases, and so there's a nice, I wouldn't say balance, because things like autos, banks are really the big heavyweights in IT in the Nifty, while things like metals and power and reality have really got very less weightage. So it's not like three sectors up, three sectors down. It doesn't really work that way. The weightages really matter, and the weightages right now are more in favor of the bearishness and a downward push on the index, and the underperforming sectors or the now performing sectors will have to do a tremendous amount of stuff to uh, overcome the negative bias from these heavyweight sectors, and those are what we already discussed on the screen. Um, but going beyond technicals, look at fundamentals. There are reasons to think that uh, the economy could get a push, and at least for some time, we could see a continuing upturn on the trend. So the trend is still long term up. Having said that, just to follow up on something I discussed a few IMRs back, the FA deep review is definitely due now, and high time that we did it. So that will happen soon. Looking forward to getting that done in the coming week, 10 days. And looking at the macro situation globally and locally, I think I would say even balance. So no market specific call. It's now more sector specific and a stock specific call. That's the nature of the market, and one has to position one's money accordingly, right? And we will do that with the large cap indices in the next part of the IMR when we do the Nifty 50 stocks review. But more and more, as I'm speaking and I'm thinking, I think it's quite clear that we probably need a broader review of more stocks, large cap, mid cap, and maybe even some of the small cap. And I think definitely, if possible, a really thorough review of the entire FNO list. But we'll hold on to that when we do the FA deep dive. We'll try and parallelly do a deep dive into the technical side of those sectors and heavyweight stocks of those particular sectors, right? So I hope it's been insightful. I know it's probably been um, a lot of ifs and buts and a lot of non-technical stuff in this discussion, but that's the nature of the market. Sometimes the markets are very clear cut, up, down, and there are many times actually when the markets are like this, major indices indecisive, some sector indices going in completely opposite directions, and that's the time that you have to really pull up your socks if you are a professional and go deeper into looking at individual stocks and deeper into individual sectors to find opportunities. Sometimes you'll find opportunities like um, the harvest is ready and the fruits are hanging from every tree, and it doesn't really matter what you pluck and what you invest in, you'll make money. But there are times like this when you have to be careful, you have to be selective, and that takes more time and effort if you're serious about making money. And we'll get down to that in part 2 of the IMR. I will be closing this session now, and yeah, let's finish it off. I'll send you a link for the next session in the in another 30 seconds. So see you on the other side. And if anybody has any questions, you know how to get in touch with us. Get in touch, and I look forward to hearing from you. Thank you, and see you on the other side. Bye.